On Bloomberg.
Welcome back to Bloomberg Open Interest. You're taking a look at stocks on the back foot right now. The S&P 500, the NASDAQ 100 a bit lower this morning. A drop in Tesla dragging down both indexes, currently off about 1.4%. It's a big company, though, and it's a big weight right now. The Russell 2000 also down a little bit, though. Small moves overall. Small caps down about 0.1%, Shanali.
And Katie, it's time now for the Wall Street Beat. Today we are looking at crypto predictions betting platform Polymarket. It is under investigation by the Department of Justice for allegedly violating its agreement with the Commodity Futures Trading Commission. Joining us with more is Bloomberg's Charlie Wells. And to put this all into context here, Polymarket, of course, has become very, very, very popular lately because of the predictions made into this election cycle. But of course, since 2022, since their agreement with the CFTC, it is to be that U.S. users cannot use it onshore. So what's going on? Put this all into context here.
Shanali, I'm just going to go out there and say this, and basically prediction markets in the United States are in sort of a puberty phase. So they're growing a lot, as you say. They're developing, but they're also going through some sort of awkward phases. And I think counting in that awkwardness is, a dawn raid by the FBI on the CEO of Polymarket. And as you say, a person familiar with the matter says that the company allegedly allowed U.S. users to trade on this market. That would be a violation of that 2022 deal that they struck with the CFTC. But it's a little bit confusing, right? Because there are other markets that are, taking off in the United States. We've got Kalshi as well. And, Kalshi, they allow election betting. And so according to a recent federal court ruling, election betting is allowed in the United States, but you have to be registered with the CFTC. Now, that brings us back to Polymarket. Of course, they are not registered. They have that deal with the CFTC, but they do not have the same type of agreement. And the real rub here, I think the interesting thing, if you're looking across all of these different platforms and you want to know why there was that dawn raid on Polymarket, something that's really interesting is that U.S. financial regulations do not allow betting on things like wars, even on things like sports. So that's under financial regulations. So you can do that on Polymarket, but you can't do that on platforms like Kalshi.
So I know that the head of Polymarket said something like new phone, who dis?
That's exactly it.
Which is like, I'm practically a boomer because I love that. But what is Polymarket's actual response to this? Because they've dealt with this before. They knew this was an issue and they took steps to address it.
It feels like really good marketing for this company, to be completely frank. But look, they have said that they are going to defend themselves. They're going to defend their community. The company also said that they felt like this was politically motivated, right? We need to remember that just last week, it was the Republicans who did have that solid sweep in the election who were touting the likes of Polymarket, saying, of course, that they were more accurate than polls, and they ended up being that way. So you get this kind of defensive posturing. You say they're going to stick up for their community. And of course, you get the CEO now front and center posting kind of funny things on X.
All right, Charlie Wells, 30 seconds. What happens next? Where does this go?
Look, I'm going to take it back to that puberty phase comment I meant. I mean, look, these markets are growing. They have a sort of air right now of invincibility. In large measure, they beat polls in the last elections. So, you pair that as well with this rally that we're seeing in cryptocurrencies. On Polymarket, of course, you've got to bet with cryptocurrencies. You pair predictive markets with cryptocurrencies with the incoming administration, which embraced both of those things. And it seems like a positive direction for travel, but maybe some legal challenges along that route.
All right, Charlie, thanks so much for joining us. Charlie Wells there talking to us about Polymarket. I think new phone, who dis is what I text the most often.
I've never gotten that text, just saying.
What?
But
Sometimes, hey girl, you up?
please don't text me that ever.
No, I just don't answer texts. So.
Markets are not up right now. We've seen kind of a little bit of a crescendo, and they've been turning down. So we're going to keep you up to date on that. Still at a obviously relatively high level after crossing 6,000 this week on the S&P. We're going to talk about Brooks running shoes as well. And this is very cool because Brooks has a partnership with Disney that
just announced.
I just found out about it. So stay with us for that CEO interview. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld.
And coming up, stocks are struggling to make headway following fresh economic data this morning and more earnings rolling in.
Trump's growing cabinet, the president-elect's latest picks reflect his emphasis on loyalty and TV. I guess skills would be one word you could use, as well as some sort of sensibilities.
Yeah, well, we'll talk about that. We're also going to talk about running. I am so excited for this conversation. The CEO of Brooks is joining us. That's after the footwear brand passes a milestone $1 billion revenue. We'll speak to the CEO, Dan Sheridan, in about 30 minutes. Before we get there, let's get a check on these markets. You can see we're just a hair below 6,000 on the S&P 500. Of course, down about 0.1%. Not too much, but still, the color is red. It's a little bit more red if you take a look at the NASDAQ 100, down about 0.3%. I will note volume pretty light today. It feels like maybe we're all just taking a little bit of a break. Then you take a look at the bond market. A bit of a rally. We're down 3 basis points on the 10-year yield, but these yield levels are so elevated. 4.41% on that 10-year Treasury yield, Matt. It has just been a rapid rise over the past couple months.
Yeah, it's Thirsty Thursday.
Oh.
You know, I think people just need a drink. It's been a week.
Yeah, I'm tired, man.
It's been a long 7-day period, and there's been so much packed in.
Remember when you said last week went by so quick?
It did. It flew by, but it was still a lot of things happened.
Yeah.
You know, and do you not get the feeling that it's going quickly?
I feel like every day lately is a full month. But
Yeah. All right. Well, a month ago, we spoke with Morgan Stanley's Mike Wilson. Actually, it was like 45 minutes ago. He says investors should be watching signals from the gold market.
The one chart that you probably haven't looked at, which I think is the most kind of bullish confirmation that there's a real change at foot, is that gold now is underperforming the stock market. So for the last year, gold has actually outperformed the stock market, and that to me is a sign that the real returns have been sort of muted.
Joining us now to talk more about this, Sitara Sundar, JP Morgan Private Bank Global Equity Strategist. Welcome to the program. Thanks so much for joining us. I think part of Mike's point was that stocks have been on an absolute tear, right? Surprising almost everybody. The median strategy estimate is where we are now for a year end. What do you think? Are you raising your S&P target?
Yeah, so I think, first, thank you so much for having me. I love being on this show. I think, look, there's a confluence of things that we need to think about when we think about equity markets. One, we just came off of a pretty solid, maybe unspectacular earnings season, but a solid earnings season where going into earnings season, the street was expecting 5% growth, and we're actually surpassing that, and we think it's going to end up closer to 7 or 8%. So I think one thing to think about is earnings continue to be strong, and our expectations, look, there might be volatility heading into year end. We think we'll be in a range-bound market heading into year end, but we actually raised our target for next year, and we're expecting the S&P to reach 6,400 by the end of next year. Now, the biggest thing that I always like to mention is what is driving that. Is that valuations or is that earnings growth? And what makes us comfortable with that target, and even after the heroic rally that we've seen in the S&P 500, not just this year, but really over the past 2 years, right, is that we still expect to see above trend earnings growth next year. Low double digits, call it around 11% year-over-year earnings growth, and that's not going to just be driven by tech, which I also think is a big point.
6,400 is only 6% higher than where we are right now. So, I mean, the pace of growth, that implies a meaningfully slower pace of growth in the S&P 500. Is there a better place to invest outside of the S&P 500 to get a better return on a percentage basis?
Look, it's the number one question that everybody is asking. We've seen U.S. exceptionalism over the past couple of years. Do we think that's going to change? And honestly, the answer is no. We still think that the S&P 500 and U.S. large cap is the place to be. We've seen a couple of things, right? We're in an easing cycle in the Fed in terms of the moves that we've seen over the past couple of months. Two, we now have certainty from an election standpoint, and we have a Republican administration and a Republican sweep. Now, historically, that has been pro-business and pro-growth. So from expectation on the broadening of the earnings rally that we expect to see, we think that's going to be supported by a broadening in economic activity as well. And then the last thing that I'll mention is that there's a difference between headline and under the hood. So yes, the S&P 500 has rallied meaningfully over the past couple of years, but 55% of those returns have come from mega cap tech. And that's where the earnings have been. But moving forward, when we look under the hood, yes, that headline 6% return, and you look at that versus fixed income, maybe it doesn't feel as exciting. However, when we look under the hood, industrials is an area that we see even a sector that we think is going to outpace the S&P 500. And the second part of that is even within technology, we've seen a meaningful rally so far this year, but a majority of those returns have been semiconductors. So we actually think that rally is going to broaden, and so the opportunities moving forward also will be within software. And we started to see that over the past couple of weeks.
Interesting. So a rally within tech, a broadening in tech.
Yes.
I actually want to rewind, though, and go just to the end of this year before we talk more about next year, because it sounds like you're expecting a sideways chop, so to speak. And the stat I keep coming back to is the fact that we're seeing 20% plus gains on the S&P 500 back-to-back years. We haven't seen that since the 90s. So when it comes to just the next couple months, are you saying because we've come so far, it makes sense that we pause a little bit here?
I think that it makes sense that we pause. We've seen a meaningful rally so far this year, but again, I will always come back to the point that headline is very different than what we're going to see under the hood. We have seen, even if in terms of expecting a more range-bound market moving forward, there will be volatility and there will be dispersion, and therefore there will be opportunities for investors, even if the headline markets are a little bit more range-bound. And what we've been telling clients to do is invest in those areas of the market where there are three things. You have durable earnings growth, you have reasonable valuations, and given the rotation that we've seen within market, there are a lot of these high-quality companies that are trading at a discount to where we think that they should be. So even now, if we're talking about putting money to work, high-quality industrials is where we think clients should be putting money to work. It's our preferred sector within the S&P 500, not just through year-end, but into next year as well. Because, again, as we have certainty around the election outcome, the amount of money that we see from a fiscal spending perspective within revitalizing the industrial complex within the United States, we have a little bit more certainty around that. And historically, what we've seen on a year-over-year basis is CapEx actually inflects higher once we get certainty after an election outcome, as CEOs feel a little bit more confident. So when we see that spur in spending, it's a confluence of factors that even into year-end and next year, that's where we see the opportunity.
Is it still, though, Sitara, you know, I've been asking a lot of people about bond yield and stocks yield parity today because I wonder, or I say, I wonder what you would buy going into a Trump administration. I know it's stocks, right? Because it's better for stocks and because we're worried that yields are going to go way higher, especially if you get these tariffs and deportations and inflation. But if yields are higher, and they're already pretty high now, isn't that bad for small cap stocks? Isn't that bad for the Russell? Isn't that bad for a lot of specific industries?
So it's a good question. I think within the small cap universe, half of that index, if you look at it passively, is in unprofitable companies. So if you enter an environment where long end rates end up being a little bit higher than what the market is even pricing in at this point in time, it can be difficult for some of those areas, which is why we prefer large cap over small cap at this point in time. However, the biggest thing to remind ourselves is over the long run, earnings growth is what is going to end up driving stock prices. We will see fits and starts over the next few months as rates start to normalize and we figure out what that terminal rate is actually going to end up becoming. However, earnings growth is what's going to drive stock prices. So even within the small cap universe, there are these high quality companies that are profitable, that we're likely going to see an inflection higher in small cap business optimism as earnings growth and economic growth at the end of the day ends up still being above potential, and that is what's going to drive a cohort of that area. But that's usually an area that we recommend active versus passive exposure, because the majority of that index is unprofitable and it's going to be give and take, whereas active managers are able to seek out those opportunities.
And, you know, we are seeing so much money flow into that Russell 2000. Will be interesting to see where this trade goes. Sitara Sundar of JP Morgan Private Bank, we thank you so much for joining us on set. We love having you here, too. Let's get a look at stocks moving under the hood this hour. We're going to bring in Bloomberg's Abigail Doolittle.
Well, the big stock moving and the stock story of the day, Shonali, take a look at the shares of Disney right now, up 9.2%. 4%. This after they put up a solid beat on the top and bottom line, but it's really the outlook. The earnings growth for the current quarter of high single digit. The estimate on the street had been 4%, so a big beat there. In addition, Bloomberg Intelligence saying that the park concerns that had been there no longer an issue while streaming was strong. Taking a look at the shares of SMCI, Supermicro Computer, not so much. Well, actually, Meta Platform down about 0.4% right now. Not a big loss there. Supermicro Computer, on the other hand, down in a big way as they continue to struggle, and a possible delisting is ahead on another filing that has not been placed. And then on a deal scrapped between Tapestry and Capri, we can see the Tapestry up 11.5%. Capri is down. This is after the FTC successfully managed to have a federal judge block this potential deal. Capri, some analysts are saying that they may have to sell off some of their brand. Of course, some of those brands, Versace, Jimmy Choo, but Tapestry investors, Katie, clearly pretty relieved.
Yeah, not too sad to see this deal go to the wayside. Abigail Doolittle, thank you so much. Now, coming up, from Gates to Gabbard, we'll bring you the latest on Trump's unconventional cabinet picks. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. ASML upholds its upbeat 2030 forecast. The Dutch maker of chip equipment is betting on AI-driven boom to continue in chip demand. That's despite a significant miss in order intakes in the third quarter. And by the way, it's a 2030 forecast. That's a little bit nuts. The board of Ben & Jerry's has accused its parent company, Unilever, of silencing it on advocating for Palestinian rights. The ice cream maker's board says Unilever is breaking an agreement to allow Ben & Jerry's to set its own social mission. Ben & Jerry's has publicly called for a ceasefire in Gaza. And rents in Manhattan have hit their highest level in 3 months after climbing in October. A surge in borrowing costs pushed the average rent to levels normally seen during the busier months. Analysts don't expect those rents to come down from here.
We're going to move from Manhattan to Washington. President-elect Donald Trump shocked Washington with his decision to nominate loyalist Matt Gaetz as his attorney general. Former House Speaker Kevin McCarthy, who was toppled by Gaetz last year in a rebellion by ultra-conservatives in the GOP, spoke about the odds of Gaetz' confirmation.
I think choices are very good except one. Look, Gaetz won't get confirmed. Everybody knows that. It's a good.
How are you reading
It's a good deflection from others, but Gaetz couldn't win in a Republican conference, so.
The announcement of Gaetz' nomination capped a string of other controversial picks from Trump in the past 24 hours. Joining us now, Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance, Matt Gaetz. I mean, you know, despite even just the House inquiry here, how is the fallout being really captured in Washington on the heels of this announcement?
Well, I think you have to look to the Wall Street Journal editorial board this morning, which starts with, this is a bad choice that would undermine confidence in the law. And I think most conservative senators, Republican senators, would look to the Wall Street Journal editorial board and agree. Many of them walking around yesterday on Capitol Hill saying they were shocked about this. But we should take a step back. I think they would like us to be talking about this idea of Trump tapping Matt Gaetz to be Attorney General. Matt Gaetz resigned last night. And while maybe they want you to think it's because he's going to go prepare for his Senate confirmation hearing to be Attorney General, what we do know from Punchbowl News is that this Friday, the House Ethics Committee was going to vote on making a very damaging report potentially public that would incriminate him. And not very nice things said about him. What we know from this report is in September, the House Ethics Committee said they were looking into whether or not he engaged in sexual misconduct, illicit drug use, sought to obstruct government investigation of his conduct, and also some questions about some of the gifts he was accepting. So if we think potentially this individual has a path, I'm not sure what that path is going to look like when already you have Senator Dick Durbin coming out in the last 45 minutes saying everything the House Ethics Committee has, we are going to need. And those senators could subpoena the House Ethics Committee and get those documents.
We'll fold this into the fact that we now have a new incoming Senate Majority Leader, John Thune. He's been sort of presented as the old guard of the Republican Party. We heard from Kevin McCarthy saying there's no way that the Senate is going to let this fly. How does the new leadership sort of factor in here?
Well, potentially the new leadership is going to be a guardrail or a check on maybe some of what President-elect Donald Trump would like to see done in Congress. He is an institutionalist to the core. He was the #2 under Mitch McConnell. Also, him and Trump have had some confrontations in the past. This was someone where in 2022, when he was up for re-election, Trump wanted him to be primaried and called him a rhino, a Republican in name only. So this is someone who is definitely on the other side, say, of the MAGA wing of the party.
So, I mean, my question is then, would he allow recess appointments, Thune, and is that a way that Trump gets through? I'm confused why McCarthy said the other picks were good. I mean, is Pete Hegseth, a Fox News host, really a good pick to run our entire defense industry, our military? Is Tulsi Gabbard really a good pick to be the director of national intelligence?
I think it depends who within the Republican Party you ask on whether or not these are good picks or not. When it comes to the DOD, does Pete Hegseth have the veteran background doing tours in Iraq, Afghanistan, Guantanamo Bay, Cuba?
Are generals going to listen to this captain who's a TV guy?
Well, the job historically should be civilian. The past few decades, we have had generals. It's not supposed to be. Biden got a waiver to get Lloyd Austin because he was only 4 years out of retirement. You're supposed to have a 7-year gap. Trump got a waiver for General Mattis. We had President Eisenhower tap the head of GM to run the DOD, Engine Charlie. The issue with this individual is he has no managerial experience, and this is one of the biggest bureaucracies in the world with a budget north of $800 billion. So I think when you ask people if he has the managerial experience in Washington, D.C., they're going to say no, especially some of these hawks that want to set deterrence on the world stage.
But does McCarthy think he's a good pick, or is McCarthy just not really thinking about Hegseth and Gabbard because they're not going to be confirmed anyway?
Anne-Marie, is some of this just posturing from the Trump administration as they start to negotiate with Congress?
Potentially. Mostly you have presidents come in a more traditional way and say, this is my pick, I want them to be confirmed. We should also note, you're hearing, can we get these people through? To this day, we still have not been able to get Congress to confirm the acting labor secretary, Julie Su.
Right.
So when you start throwing out all these names, and confirmations hearings can be very hard. The only one really on the board that's going to have a foolproof, easy confirmation hearing is going to be Senator Marco Rubio. And that's been welcomed and cheered along on bipartisan basis. When it comes to someone like Tulsi Gabbard, again, she's an isolationist within the Republican Party. Someone who already the Russian media is saying our girl Tulsi is going to be on the in. Someone who has spoke that the fact that Syria's President Bashar al-Assad is not an enemy of the United States and went and met him. She views enemies and adversaries similar to Donald Trump does. An enemy, urgent individuals that need to be destroyed, adversaries, people potentially you can do deals with. Is this someone, though, the very conservative, hawkish members of the Republican Party are going to want to see through? It's going to be difficult. There's only right now 53 seats, and no Democrats are going to line up for that pick.
All right, Anne-Marie, we have less than a minute left with you. We've gotten a lot of picks. Let's talk about what we haven't gotten.
Treasury Secretary.
When are we going to get it?
It's an interesting one that everyone is waiting on. And the Wall Street Journal has a report today that Howard Lutnick, I call him the producer, he's co-head of the transition. Now he wants to be the star. He himself put his name in the ring, according to the Wall Street Journal. The other main contender is Scott Bessent, which a lot of individuals in the Trump world are really lining up behind. He's been working with the Trump campaign over the course of the last few years, last few months, even traveling with the president recently. So we'll have to see. But that is the next name everyone wants to hear drops. Because once we know about the Treasury Secretary, then we can find out maybe who's running the SEC, who's going to run the FTC, and who's going to be the director of the National Economic Council.
All things that people who watch Bloomberg TV care deeply about.
Yeah, but I think Bessent's too safe. Given what Trump has been doing over the last 24 hours, I feel like he's got to pick Lutnick.
Well, I think Trump understands that financial markets care about two picks out of all of these. And it's Secretary of State, and he went for a conventional thinker in Marco Rubio that the markets liked and Washington liked. And he might want to do that as well with the financial markets. There's one thing that does regulate Donald Trump, and Jonathan Farrell says this all the time, and it's the Dow Jones Industrial Average.
Wow. I think that's a diss from Farrow, because he feels the same way about the Dow as you do, Katie.
That's funny. I guess he's not, Trump isn't watching the small caps.
All right, Anne-Marie, great having you on. I hope you can come over here more often.
Whenever you want.
Well, you know, leave your surveillance chair and come join us. Bloomberg's chief political correspondent and co-host of Surveillance with John Farrow, Anne-Marie Jordan. Still ahead, leadership changes at LVMH. We got the latest on succession talks at the luxury giant next. This is Bloomberg.
All right, it's time now for Social Climbers, the companies making waves this morning. And first up, LVMH appointed new divisional leaders, including the return of one of CEO Bernard Arnault's sons to the Paris headquarters. Alexandre Arnault will serve as deputy chief of the company's wines and spirits division, leaving his New York-based position at Tiffany's. That reshuffle, of course, is fueling succession talk. Next up, Palantir defying Wall Street skepticism. Shares in the AI maker of software are up more than 250% this year. That's despite questions around Palantir's sky-high valuation and the sustainability of revenue growth. And finally, let the games begin again. For the creator of Squid Game, the most popular show in Netflix's history, writing and directing the first 9 episodes was so intense that he lost 7 or 8 teeth. But he put his dental worries aside to write more episodes, and on December 26th, an equally violent second season is set to hit the screens. Probably good news for Netflix, maybe not good news for that guy's mouth. Anyway, coming up, I'm really excited for this conversation. We'll be speaking to the CEO of Brooks Running, Dan Sheridan. He joins us next. This is Bloomberg.
Bloomberg.
Well, Well, one of the world's leading running brands is in a whole new race. Brooks Running crossing the $1 billion revenue mark for the first time before the start of the fourth quarter this year. And that success due in part to a 10% sales increase in North America. For more on the company's success, I'm pleased to say we're joined by Dan Sheridan. He is the CEO of Brooks Running. And Dan, it's great to have you with us. When we think about how far you've come this year already, is the pie growing or are you stealing share from some of your competitors?
Yeah, good morning. Thanks for having me. It's a little bit of both, to be honest with you. This category is incredibly strong, and it really comes from the participation in the sport. We're seeing more people around the world choose health and wellness. And Brooks, to be clear, has been on this trend for over 20 years. You know, we've been a brand that's grown almost 15% compounded over that time frame. And so these results are just a continued focus on this category. We're so fortunate to be focused on a consumer that's healthy and a category that's healthy. So we're doing a little bit of both. We've got wind at our back, but we're absolutely stealing share from our competition.
Well, let's talk about a potential headwind, and I'm referring, of course, to tariffs, the possibility that, especially for goods coming from imports coming from China, 60% levels next year. When you think about what that would mean for retail, for shoes, how are you planning around that?
Yeah, you know, for Brooks, we're a global company, so we focus a lot on global trade and policy, and tariffs are something that we deal with every single day here at Brooks. And, you know, if there was to be an increase, which it looks like there will be, you know, what we focus on is our supply chain, creating redundancy throughout our network, creating agility as well. But the truth is, for the whole category, not just for Brooks, this would be a headwind for us. And, you know, we already have high tariffs on footwear. You know, out of Vietnam, we pay about 20% on a tariff basis. Out of China, it's 27%. So if these tariffs come through, it will impact us as a brand, but it'll impact the entire category of performance run.
Hey, Dan, what level would tariffs have to rise to before it became, or for it to become economically feasible for you to make your shoes all in America? I mean, at what point do you say, okay, that tariff is too high, we're going to make these shoes in Seattle?
Yeah, we talk a lot about that, Matt. You know, what we're focused on, though, is really trying to get closer to market throughout our entire supply chain. So there's a number there that you know, we model out. But the truth is our entire supply chain and the industry's supply chain is in Southeast Asia. And to move that closer to market domestically would be really challenging. The entire supply chain through tier 2, 3, and 4 is throughout the Southeast Asian market for performance runs. So the truth is it would take a long time for us to get domestic in our manufacturing base.
Dan, I understand you've recently said that you can't pass off the total cost to consumers, but you know, you look at your website, a pair of women's adrenaline running shoes are $140. Post the new set of tariffs, what would that price be?
Yeah, I mean, we look at it in terms of the trends in the market and the category specifically. And the truth is, Shonali, that we would not be able to pass all of these tariff costs on to the consumer. So we're lucky. This category is growing really healthy, above $130. In a rolling 12 months, it's growing 38%. And so we do have some pricing power because performance matters, and we sit in the center as the leader of performance run here in the U.S. And so pricing's one of the models we work on. And the truth is we just wouldn't be able to pass that on. We'd have to eat some of that cost, which impacts our organization in terms of hiring and R&D and the like. So again, tariffs would be a headwind for this category.
Well, definitely hope to speak with you about that once we get some clarity on tariffs. But I want to talk a little bit more about the competitive landscape, because you said at the start that it's both a combination, your growth of taking share, but also the category growing overall. But when it comes to how you sell shoes, you think about what went wrong with Nike, for example. They cut ties with many of their retail partners. Have you been able to fill that shelf space? Are you selling more at stores that maybe aren't Brooks specific?
Yeah, so we think about it maybe a little differently. You know, we set up first and foremost focused on the runner. And the runner is the customer that we have a maniacal focus on for a lot of reasons. One, it's a pretty consistent growth trend over a 20-year period. We're growing about 10% right now throughout the world. We're the #1 brand in performance run. And the reason we are is because we set up as a multi-channel brand. We sell across channel. Simply because the runner researches brands, they purchase brands, and they try brands in every channel of distribution. And it's important to our strategy to set up locally because that's where running happens, in the local markets. And we always say there's about 10,000 communities of runners around the world, and we're executing on behalf of those local markets and winning. Here in the U.S., we're the #1 brand in market share for run.
Yeah, and I mean, it's a great point that you think about the average runner. They go to their local running store. They try, right. They test out shoes. It's interesting, though. You think about, you, of course, started as CEO sometime in the past couple months in April. I believe it was in June that you told Fortune that you're taking a look at Brooks and thinking about merging into lifestyle brand territory. Talk us through that decision tree about deviating away from the core mission of just running.
Well, I would tell you this, that our focus is performance run. Every single day we get up and all we think about is runners here. It's very unique against our competitive set. We aren't focused on other categories in sporting goods. And so our groups every day build product that will work on the run first and foremost. But we're also addressing a broader consumer set, walking, the gym, all of the categories that running shoes are used for. And what we've seen over the last 4 or 5 years is just an explosion in the broader use cases. And so what we're doing is we're anchored on performance run, and then we're expanding our brand to anyone that puts one foot in front of the other. And that's why we're getting these results and winning the runner every single day in these channels.
You know, speaking more to the competitive landscape, your rivals are changing quickly as well, and some of them have seen kind of choppy uptake. You think Lululemon in the shoe business, you think Nike with the new CEO, and you think about the way that they are trying to double down on footwear and on lifestyle. How do you feel like you will have to react over the next year or so?
Yeah, we have a saying at Brooks, sharp focus creates mass appeal. And so our focus is our advantage. And every single day we focus on this consumer. And the truth is product wins. Product wins every single day with the runner. It matters every day whether the shoe is going to work for the runner. And the worst thing that could happen to a runner is they get injured. So we design shoes based on science first and foremost. And our competitive advantage is that we're really good at that. The secret sauce for Brooks is fit, feel, and ride. Every single day, a runner chooses Brooks, and we've been able to do that. So when we look at the competitive set, we're really competing in product and brand. And right now, we've got a product pipeline that is winning around the world. We just launched a Max shoe called the Glycerin Max, which is absolutely an innovative product that is winning runners every single day in every one of our markets. You know, in China, we had the #1 shoe on Tmall with the Glycerin Max when we launched it. So you can see how it's resonating in all the markets.
We're going to get a pair of Glycerin Max shoes for Katie and have you back on in a couple of months after she's put some miles on them. Dan, thanks so much for joining us. Dan Sheridan there of Brooks talking to us about the running shoe market. Right now I want to get a check on what's going on in the stock market, and for that we go back over to Bloomberg's Abigail Doolittle. Abby?
We're seeing relatively small moves across a lot of different asset classes. At this point we have the S&P 500 down slightly. Earlier it had been higher, but overall that Trump trade that started on the election day, and actually you could argue before that, mid-September, really basically in place, even with this small loss. Yields not as much, but it's a small move to the downside after PPI and other considerations taken into account at 442. NYMEX crude off of its highs up just a bit, and then the dollar slightly higher. This is another piece of the Trump trade. If we go into the Bloomberg terminal and take a look at what's been happening with the dollar both in the month of November and October, right now we are looking at back-to-back 2% gains. The first time we've really seen something like this going to mid-2022. So the expectation of a Trump administration being protectionist, supporting that strong dollar, well, right now we are certainly seeing that in spades. And then finally, beneath the surface, lots of movers. Disney shares popping higher right now, up about 8.1%. They beat top and bottom line expectations. In addition, the EPS growth, the earnings growth for this current quarter expected to be high single digits versus the Wall Street estimate of 4%. Parks okay, streaming good. Charles Schwab up 3.6%. They gave their their October monthly update, and they do have $24.6 billion in core new net assets. Investors liking that. Super Microcomputer, on the other hand, down 7.9%. More bad news here, sort of expected bad news, I would say, in terms of their delaying the 10Q filing and delisting from the NASDAQ. Well, that's a real possibility. And then Hims and Hers down sharply, down 15%. This as Amazon provides some competition entering the telehealth space.
All right, Abigail Doolittle, thank you so much. Now, coming up, AI's impact on the entertainment industry. We'll hear from Jonathan Taplin of the Annenberg Innovation Lab next. This is Bloomberg. All right, it's time for our daily Wall Street Week conversation. And generative AI is being implemented across multiple industries, including entertainment. David Weston spoke with Jonathan Taplin of the Annenberg Innovation Lab about AI's threat to those in creative fields.
They're going to certainly employ it in the production end of making animated films, making special effects for, live features. And so in that sense, it probably will be productive. But obviously the two strikes that were in Hollywood last year were about trying to preserve the profession of actor and trying to preserve the profession of writer and not have that overtaken by AI. Whether that battle will continue for another 5 years is an open question.
Generative AI, of course, requires enormous sophistication and computing power. Is it possible that the high-tech firms, the so-called hyperscalers, may actually take over a lot of the roles that are now played by entertainment companies?
Well, certainly many companies have found that it's speeding up their code writing. So in the simple sense of writing new code, AI is helping that. But on the other hand, many companies have tried to adopt ChatGPT and stuff like that, and many companies have decided it's not really worth the money. So, I think the jury is still out. There's obviously extraordinary hype artists like Elon Musk who are very good at promoting things, pushing it. But whether it will end up being the save-all of the industry, I don't know. There's clearly billions of dollars being invested in it, and whether it turns out to be Pets.com or it turns out to be Google is an open question.
So we're on Bloomberg. Give me some investment advice. As you suggest,